In this chapter, we're going to be covering job order costing. And while the name might be a little misleading, job order costing by itself doesn't just include custom order jobs of one unique batch. It's used for any type of system where things can be separated from one another. So if you have different products within your company, you can use job order costing to determine the cost of individual products. If you're a service business that does contracts with different customers, you can use job order costing to determine the cost of providing that service to different customers. So yes, you can use it for unique custom order projects. But if you have a way to delineate your product offerings or your customer base into different categories, you can use job order costing to assign cost to those particular categories. So, some examples in practical terms, home builders. Every home is a job unto itself. They don't mass produce 50 different houses at a time. They make one by one, go down the line. So each job can use job order costing. Production of custom built furniture, same thing. You're going to make cabinets or tables and chairs in either one product or very small batches. You can keep track of all the cost that goes into making that singular product or those batches. Computer system installation could be in there. A good one is the production of a movie by a film studio. All of the cost of cast and crew and advertisement and all of those things can go into the cost of making that movie, making the new Star Wars movie for Disney. Legal services provided by attorneys. They know exactly what customer they're providing service to at any one given time, what client they're working on at the moment. And because that's traceable, they can assign their cost to clients on a client by client basis. Catered meals for a restaurant, same thing to figure out what your total cost of catering would be for a particular job. Well, you know what food that job ordered. You know how many hours it took your chefs to cook it. So you can use job order costing to determine the cost of that job. So, what type of costs get assigned to a job when you're using job order costing? And there's anything, the big three that are for a production company, your product costs. Your cost of direct materials, the actual inputs that went into the construction of that job or that were needed to provide those services. Direct labor, the labor time, the human effort that went into the production of that job. And then on top of that, there's manufacturing overhead, costs shared by multiple different jobs that need to be spread out in one way amongst those jobs. And the two big components of this are indirect materials and indirect labor. Indirect materials are small, insignificant things like, I don't know, pens or glue or solder or whatever that could go into a job where it doesn't make sense to keep track of exactly how much was used for that job. It's just not cost efficient for something that's such a low cost material. And you would instead pool that and figure out how much was used across all jobs and figure out some way to spread it out amongst the different jobs that it helped produce during the period. And the same is true for indirect labor, the support workers who support the manufacturing staff but aren't actually in charge of manufacturing product. Security, at a production facility is making sure that the people who are producing each and every job are secure. So that is a shared cost amongst all of the different jobs. You would take that security guard's cost and find some way to spread that cost out amongst all of the different jobs because while it's not directly a cost that's directly involved in production, it indirectly helps the production effort. For indirect costs, keep in mind that you don't throw all indirect costs in here. There's a very important term back on the last page, and that is manufacturing cost. If you have an indirect cost that's not directly related to the manufacturing process, well, it's not a product cost. So advertising, executive salaries, etc., they have nothing to do with the process of manufacturing. They're basically those things happen either overarching for the company or after the product is finished being produced. You only want to inventory the indirect costs that are related to manufacturing that help you produce the goods that you're making or provide those services. So for manufacturing firms, if it occurs in the factory, it's more likely than not, it's a product cost. Now, it might not be a direct cost that you can assign right to the job, but it should go into that manufacturing overhead pool and be spread out to all jobs. So how do you trace the costs to jobs? Well, for two things, it's incredibly easy. It is direct materials and direct labor. You know exactly what materials are used for the construction of each job. You know exactly the labor time that was committed to producing that job. So for materials and labor, you can assign it directly to that job. With that, some of those indirect costs will go in there. And as you're doing this, you are not expensing those costs as they go because they're product costs. They have to flow through inventory, as they say. So all of those costs, which for period costs would be expenses like salary expense, the salary of your manufacturing employees doesn't get expensed at the time. It gets put in your WIP account, your work in process inventory account. And then when you're done manufacturing that good, it's no longer a work in process. It's a finished good. So all those costs get transferred to finished goods inventory. And then you finally expense all those product costs at the time you sell stuff through cost of goods sold. So let's do an example right here. We're going to be Everring. And Everring produces tungsten wedding bands. We have a stockpile, a storage room somewhere full of tungsten and nickel that we use to make rings. Those are our direct materials or our raw materials for the production here. And we need somebody to turn those raw materials into a shaped wedding band. So labor is also something that is needed for production. We got direct materials, we got direct labor, and we can trace those right to the production of each specific line of wedding bands that we make. And assuming that we make many different lines of wedding bands, some costs are going to be shared by all of those different models. And those will be things like our indirect material usage, our indirect labor, the utilities at the factory where these things are produced, and depreciation on equipment, which is used to produce all of the different lines of product that we make at Everring making wedding bands. So in graph form, we got someplace over here that stores all of our materials. Some of them are direct, some of those are indirect. But when we use those, we take the costs out of direct materials and we put it into WIP. So you can think of it as the cost matching the physical flow of inventory. When it's no longer a raw material sitting in storage, it comes out of there because those materials physically got moved into the production floor where they started being part of a work in process. And we'll keep doing this over and over again. We'll accumulate material costs as we take things out of storage and put it into WIP. People need to do some work to operate machines, etc., to turn those materials into a product that we're eventually going to sell. So those labor costs, as they're working on it, those get traced as well. And then we'll find some way in here to spread all of our overhead, all of our shared indirect manufacturing costs amongst the different product lines that we have. But they will, in fact, go into that inventory because while this inventory is a work in process, we're going to depreciate equipment. We're going to use utilities. We're going to use indirect materials, and our indirect labor's got to provide support to the manufacturing staff. So all of those product costs get contained in WIP until WIP is done, and then it gets moved to finished goods inventory. And then finally, when we sell, in this case, these wedding bands over here, that is when the expenses occur through COGS. If you want to look at it in terms of T accounts, we got the same thing here. We would have cost in our direct materials inventory account represents our raw materials sitting in storage as they get requisitioned for use. In jobs that are a work in process, those costs come out of the direct material account and they go into our WIP account. And should mention right here that anything that ends with the word inventory is an asset account, which means it increases on the debit side and it decreases on the credit side. So as we are moving those costs through our various stages of inventory from direct materials to WIP to finished goods, whatever account it's coming out of would have an entry on the credit side of the T, and whatever account it goes into, it would be debited on there. So we move those costs of direct materials into WIP. For our wages payable over here, that's a direct traceable cost. So as we accumulate wages payable, liability account goes up on the credit side. That cost would get transferred directly into work in process inventory, our second cost component. And then for overhead, the rule of that T account is that actual costs are accumulated on the left-hand side. That's where they go into the shared pool, and costs come out of the pool. They come out on the credit side. And those costs that went out of manufacturing overhead would go into WIP. So now we'd have all of those costs in WIP over here. And then during the period, we would finish some of those goods. So all of the costs that were accumulated while it was still a work in process are now going to be transferred to finished goods. Again, asset accounts, whatever account it's leaving as it's flowing through inventory is always the credit. So this is going to come out of WIP and it's going to go into finished goods inventory. And from there, once we sell it, it's got to go out of finished goods inventory, and finally it ends up in COGS. Now, you can't just have T accounts without having everybody's buddy, the journal entries. So what do the journal entries look like? Well, if you are accumulating costs in your manufacturing overhead pool, costs are accumulated on the debit side. So every time you have an indirect manufacturing cost, MOH is going to be your debit. The credit in the journal entry is the reason that you are accumulating that manufacturing overhead. So if we have indirect labor, well, the reason is because of wages that happen here. So if we still owe them to people, which you can probably assume is going to be the case, the credit would be to wages payable. If for some reason you paid cash wages at the time, it would go into cash. When you purchase materials, and I actually disagree with McGraw-Hill on this one, but that's okay, you would have to put the cost of indirect materials into manufacturing overhead. So they have it as one joint entry here where they're putting the cost of the purchase accounts payable as the credit. I would actually purchase this and put it into raw materials as our debit originally, and then accounts payable as the credit, and then have a second entry where it's going into manufacturing overhead by coming out of your raw materials inventory. But it's all semantic. It's just another step. It ends up with the same spot at the end because you're transferring it in and out of the same account. You are going to end up with a debit to manufacturing overhead to increase the cost of the pool. And you're going to have a liability on your books for what you owe the vendor for those indirect materials that you purchased. For utilities over here, again, if it doesn't get expensed at the time, if it's a product cost, it's got to go in your manufacturing overhead pool and flow through inventory. Your credit's going to be to either utilities payable, if you still owe the utilities, or cash. And then for depreciation, this one's guaranteed. Every time your manufacturing overhead, manufacturing equipment depreciates, the debit is the manufacturing overhead, and the credit is to accumulated depreciation. And as I said before, for inventory accounts, whenever costs go into them, they go in on the debit side. So as you accumulate your three different cost components into inventory as it's a work in process, for every one of those, you're going to debit WIP inventory. And the credit is where it came from. In this case, this came out of direct materials inventory. It's going to go into WIP. For direct labor, we would have some account over here. They could be, I'm assuming they mean direct labor payable or something along the lines over here. Account that represents the money owed to our laborers. And then down here, when costs come out of the overhead pool, they always come out on the credit side.